Debt Market Outlook June 2023. We present a matrix detailing some movement in some key market rates, domestic and global, and key events. It was a steady month with a softer rate bias for domestic fixed income markets. The benchmark 10-year gilt moved down by around 12 basis points, BPS, to close at 6.99%, witnessing a one-year low. Yields softened across the yield curve, with the extremely short end reacting to the overall liquidity surplus in the banking system. Inflation measured by CPI fell to 4.70%, marked by a slowing momentum in the core inflation and a drop in food inflation. The Q4 GDP of financial year 23 surprised on the upside and printed at 6.10%, thereby the real GDP for financial year 2023 growing at 7.2%. The strong print was a reflection of healthy fixed capital formation and export growth. However, private consumption continues to exhibit weak growth during the last financial year. Looking ahead, we believe that the monetary policy of RBI will have an extended pause. Many global central bankers also seem to be in a pause, wait and watch mood. We believe that there could be an extended pause by the MPC. It raises the probability of a reversal in monetary policy action previously taken. History has a strange way of chiming, and it may be felt this time too. Commodities, including agri-commodities, and crude continue to remain soft. Such softer bias leads to the possibilities of lower inflation bound, albeit lower than the RBI's projection. With urea prices coming off and an increased RBI dividend, the budgetary borrowing numbers may reflect a lower number as we go through the fiscal year. The softer bias in interest rates may well continue through this calendar year. The bare flattening of the yield curve, especially in the 1 to 5 year segment, has largely happened, hinting at the possible end of the upward movement of the domestic rate trajectory. We also believe that AAA credit spreads have increased yet remain richly valued based on historical measures. With US Fed trying to engineer a soft landing to the economy, there has been historically no precedence of inflation remaining high after a recession, which possibly also bodes well for fixed income allocation. What should an investor do? While there have been tax changes announced in the debt segment, we still believe, beyond the tax changes, the merit for debt mutual fund investments continues. We believe that investors with a shorter time horizon of less than 1 year may continue investments in ultra-short-term and low-duration funds. Short-term fund category may be suitable for investors looking to stay for a time horizon beyond 1 year with a lower risk volatility. For investors who attempt to capture the interest rate cycles, an allocation to a dynamic bond fund merits attention. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.